for the 8th of September 2018. This Week in Economics from WBRN Radio and on the Bostonred Network. We look at this week's economic situation. We have the latest from the Bureau of Economic Analysis here today, and we'll do sort of a little summarization here. This is presented a joint venture with Cranston Analytics. As normally we are, we'll give a little summarization again of what's going on here. Gathering from Reuters, headline here, strong U.S. sales could ease profit worries into 2019. And from the Apple company, this is also from Reuters, U.S. tariffs on China would hit a wide range of products. And from the BBC, their headline is U.S. wage growth hits 9-year high. We hear a lot of this going on. And some caution from Dr. Larry Summers. He was speaking at an economic lecture at the Boston Federal Reserve. He is, of course, a former Treasury Secretary and talking about the recent results of the Federal Reserve's stress tests. From Bloomberg on the American worker, workers win bigger pay gains by becoming more productive is their headline on the 8th of September. We'll be talking about this. And also we'll be looking at crop diversity from the agricultural sector, what crops are being planted now and what crops are not being planted, and how they have changed in terms of priorities. As they call it, globalization, ebbs and flows, period. And where crops are now, that they were not 10 or 15 years ago. And we'll look at Detroit and the automobile sector, why Detroit's hubris makes this the best time to buy a new car. And we'll look at that. And we'll also look at a cryptocurrency. Coinbase, a cryptocurrency powerhouse, has doubled its staff to 500 amidst the market rout. This is from the Business Insider. So we'll start out with the employment situation as we usually do here. The date on this is September the 7th, 2018. The non-farm payroll, and we're still using the word non-farm. That is a carryover from the days of that farming was much more important and larger numbers of people were engaged in farming at that particular time, and for some reason we still have it out there. The farming payroll has decreased over the last 50 years and is steadily decreasing now because of increased mechanism, and we'll talk also about different crops that are out there. Nonetheless, increased by 201,000 in August. The rate of unemployment and redundancies at 3.9%. That's from the U.S. Bureau of Labor Statistics. Job gains occurred in professional, business services, healthcare, wholesale, transportation, warehousing, and mining. As we normally do, we start with the household survey. The unemployment rate remained at 3.9%. The number of unemployed persons at 6.2 million. Amongst the major worker groups, the unemployment rate for adult men at 3.5%, adult women at 3.6%, teenagers at 12.8%, for Europeans 3.4%, African Americans 6.3%, Asians at 3%, Latinos at 4.7%, little change. In August, the long-term unemployment, those jobless for over 27 weeks, was little changed. In August at 1.3 million and accounted for 21.5% of the unemployed. Over the year, the number of long-term unemployed has declined by 403,000. The labor force participation rate at 62.7%. Excuse me. And the employment population ratio at 60.3, declined 0.2% in August. The number of persons employed part-time for economic reasons, sometimes referred to involuntary part-time workers, at 4.4 million. Changed a little over the month, but was down by 830,000 over the year. Slightly under a million individuals who had preferred full-time work working part-time. In August, 1.4 million persons were marginally attached to the labor force, a little different from a year earlier. These people were in the labor force, wanted and were available for work, but they did not find it. Amongst the marginally attached were 434,000 discouraged workers in August. I talked to some discouraged workers on Friday, essentially unchanged from a year ago. Now to the establishment survey, we had the household total non-farm payroll increased by 201,000, in line with the average of 196,000 over the 12-month period. Professional and business services added 53,000 jobs in August and 519,000 over the year. Healthcare services rose by 33,000 with job gains in ambulatory healthcare services at 21,000, medical centers 8,000, healthcare added 301,000 jobs over the year. This is diametrically opposed to critics that said that the Affordable Care Act would destroy the healthcare industry. Wholesale trade employment increased by 22,000 in August, up by 99,000 over the year. Durable goods wholesalers added 14,000 jobs over the month, accounted for 2/3 of the overall job gains in wholesale trade. Employment in transportation and warehousing rose by 20,000 in August and by 173,000 over 12 months. Within the industry, couriers and messengers added 4,000 jobs. Mining employment, we're starting to see more realistic figures here. Increased by 6,000 in August, showing little change from July. Since a recent drought in October 2016, the industry has added 104,000 jobs, almost entirely in support activity for mining. Employment in construction tends to trend up, 23,000, increasing by 279,000. Manufacturing changed a little in August. Actually, it was a negative. We're starting to see that number come in 3,000 over the year. Employment in the industry was up by 250,000, with almost 3/4 of the gain in the durable goods component. That's in manufacturing. Employment showed little change over the month in other major industries: retail, trade, information, financial activities, leisure, hospitality, and government. The average work week for workers, it was at 34.5% in August. Manufacturing work week held steady at 41 hours. Overtime was unchanged at 3.5. The average work week for production workers was 33.8 hours for the 5th consecutive month. In August, the average hourly earning for all workers rose 10 cents to $27.16. Over the year, the average hourly increased 77 cents, or 2.9%. The average hourly earning of private sector production workers increased by 7 cents to $22.73. Now, this is to contrast with for all workers in private, and it make the difference non-farmer. We'll try to get around that. It rose by 10 cents, and that was $27.16. as opposed to production workers at $22.07. The changes in a total non-farm payroll from June was revised down 247,000 to 208,000. The changes for July was revised down at a plus 157,000 to 47,000. With these revisions, employment gains in June and July combined were 50,000 less. The summer months can be a bit on the volatile side, not unusual there, but it appears there was a little bit of revising up rather than revising down. Monthly revision resulted from additional reports from business and government agencies since the last published estimate. After revision, job gains have averaged 185,000 over the last 3 months. It's not unusual. I'll kind of dive a little bit deeper into this. In July of 2017, civilian labor force was at 160,000. In June, it was at 160 million. I'm sorry, and it 162 million in June, and basically the same thing in July, 162 million. In August, dropped a little bit to 161 million. The changes were 223,000. The participation rate has been pretty much at, in August of last year, 62.9. In June of this year, 62.9. And in August, 62.7. It fell a little bit. This is the labor force participation rate. The employment population ratio last year in August was 61.1. This year it is at 60.3. And the difference here is a negative 0.2. The unemployment rate was 4.4% last August 2017. And in July it is at 3.9% of this year, and still 3.9%. And we'll look a little bit at ages here in terms of where workers were. Unemployment rates, adult men 20 and older. Last year it was that was in August 4.1%. In July 3.4%. In August 3.5%. Adult women 20 and older. Last year it was 4%. This year 3.6%. You can see where this is going. For teenagers 16 to 19, it was 13.8% last August. This August it is 12.8%, a negative 0.3% there. For Europeans it was 3.8% last year in August, and this year it's 3.4%. For African Americans it was 7.6% in August of last year. And you can see basically where this is going. In June it was 6.5%. In July 6.6%, rose a little bit, and in August 6.3%. So negative 0.3 there. Yeah, let's see. For 25 years and older, with less than high school diploma, not very many of those around. Last year was 6.2%. High school 5%, and with college or associate degrees 3.8%, and with bachelor's degrees 3.2%. And if we go over, I believe, let's see, we look at these scales here. That dropped for bachelor's degrees to 2.1%, so we had a negative 0.1%. For high school graduates, doing a little better at 3.9%. They were at one time last year at 5%, so they're down, what's that, percentage, 1.10%, I believe. My arithmetic goes right. Some colleges, they were at 3.8% last year and at 3.5% this year. Get my columns going here, right? Just make sure I'm... Yeah, and August 18 is the last one over. So we kind of see where we are. So 0.3% basically is what has happened here. That change, incidentally, was from July of this year to August, and really we're not too interested in that. Job loss in person who completed a temporary job work, 3 million there, and 2,875,000. Duration less than 5 weeks, roughly about the same, from 2,221 to 2,208. The part-time workers, I think we went over that. 5 million of those were out there last year, and 4,379 this year. Slack of work or business conditions, there were 3,232,000 last August, and now we have 2,501,000. And this is establishment data here. Won't go very much into that. If we look at last year, non-farm 221 is 201 in August. So you can see a drop here. It is seasonally adjusted. You change in thousands. So we look at construction, 28,000 August of last year, 23,000 this year. And retail trade should be hammered pretty much here. Retail trade 3.6, and this year at 22.4. Leisure and hospitality last year was at 4, and this year at 17. A little more lackluster there than we looked at our, let's see, average weekly hours at 34.4. It's 34.5 this year in August, and the average hourly earnings $907.82, and this year you can see where it increased here to $937.02. So roughly what, 20, let's see, we look at it there. Well, we can actually get that. $20 basically, a little over there. And that is the end of that particular sector. We'll go to Reuters here. Strong U.S. sales could ease profit worries. Healthy outlook for the U.S. Revenue growth stands to smooth stock investors' worries about the effect of corporate profits from tax cuts wearing off next year. The revenue growth hit 9.5% in Q2. It's the fastest pace since 2011. It's estimated at 8.2% for 2008. That's according to Thomson Reuters. While the growth is expected to slow to 5% next year, it's still at the high end of historic average. The fallout is not as steep as expected in earnings growth, which received a boost this year from tax cuts and a Jobs Act. This can ease some investors' concerns about profit growth and is hitting its peak for the cycle this year, while risks are increasing for costs related to tariffs, rising interest rates, and a strong dollar. Several things going on here at once. The revenue growth more than offsets any concerns we have on earnings. That's from Samira, global equity and technical strategist at Wells Fargo in St. Louis. And of course, there is a peak earning growth. We have tax cuts, he said. We want to see sustained earning growth driven by the top line, which is exactly what we're seeing now. Revenue gains are being driven by strong demand from economic growth, with domestic product rising at 4.2%. That was in Q2, the fastest in 4 years, but that was kind of a blip going on there. The data on which we just reviewed on Friday notched the largest annual increase in 9 years. Rising wages are likely to be a bigger risk to earnings at some point, but might not happen until 2020. That's wishful thinking. Most economists polled by Reuters in August expect economic growth to edge off the record 4-year high in the coming quarter, but still little change there. The S&P 500 growth at 23.3% in 2008, the highest annual since 2010, and at 10.2% in 2019. These earnings estimates are always normally exaggerated. Earnings growth estimated at 29.9% in Q2 from a year ago. Analysts expected 22.3% in Q3. This is Thomson Reuters. Results continue to increase even after growth peak. For example, the S&P growth peaked in Q4 of 2003, yet remained in the double digits for 3 years. Well, yeah, and then there was a depression. In the last 80 years, S&P earning growth averaged 6 to 8% a year, while sales grew at 3 to 5%. Early indicators are that this is looking like 2003, where we can see above the trend persisting. We can see the trend persisting above a longer than consensus expects. Well, first of all, 2003, I have to look back there. There were recessions coming at those periods, and by not as hard as the depression that came in 2008. But also at the same time, you did not have in 2003, and this is something that needs to be pointed out, the continual globalization of the economy. And that is our theme throughout our reports. Let's spring along here a little bit. Apple, tariffs on their various products, components come from all over the world. Apple, including the Apple Watch, would be affected by proposed tariffs on, of course, Chinese goods, but no sign of impact on the cash cow, the iPhone. Apple Watch may be the biggest seller. It brought about $6.1 billion in revenue last year, according to estimates from Bernstein, the analytics firm Bernstein. That represents a small portion of Apple's $250 $29 billion overall sales. Trump administration has $200 billion worth of Chinese goods in an unsigned letter. Tariffs have additional $267 billion in Chinese goods. The AirPod earphones, some of Apple's Beat phones, and now HomePod smart speakers also face levies there in the Chinese sector. The iPhone actually accounts for 2/3 of Apple's $229 billion revenue in the most recent fiscal year. The letter also made no mention of iPad, which brought in $19.2 billion in sales, or most of its Mac computers, which generated $25.5 billion. So you can see the phone is moving along, and the Apple Mini Mac, that's a low price computer, comes without a keyboard or mouse, would be affected. But these items here are sort of out there, not anything big. Tech sector is one of the biggest potential losers in the proposed $200 billion tariff regime. We'll get back to the BB. Well, we'll do it now when we're here. Apple and Amazon, the battle of the titans. This is from the BBC. Amazon's market value of $1 trillion. That's 779 billion pounds. Just over a month after Apple became the first public company in the world to achieve such a feat. Both tech companies have grown over the last few years, but will this continue? Apple and Amazon are as different from each other as apples and oranges. Apple is a tech company that is also a trendy consumer brand. Its computers and devices have often been a must-have gadgetry, I guess I'd call it gadgetry. Since the iPhone first went on sale, it was in 2007. Apple shares have soared 1,100%. Amazon, the internet retail giant, has seen a steady growth, yet speedy rise in its share price. The market value of it from just 16 days at 700 billion. In contrast, it took Apple 622 days, roughly 2 years. Amazon's value topped $1 trillion. Amazon's first server is strong enough. The Apple market value hit $1 trillion. It's sort of where the going gets here, and who will come next? No doubt Google and some others. Device sales. Traditionally, most of Apple's revenue has come from device sales, iPhones, iPads, Macs, etc. Apple only has 14% share of global smartphone market. Yet revenues consistently dwarf its competitors. Strategic Analytics, the first quarter 2018, Apple captured $61 billion in revenue, whereas Samsung $19 billion, followed by Huawei of $8 billion. But their phones are cheaper. Apple's dependency on I/O devices has been its strength, but moving forward presents its greatest challenge. That opportunity to grow user base will be limited, as Juniper Research, ahead of forecasting and consultancy, Windsor Holder tells the BBC. We don't believe revenue will decline, but the opportunity to generate significant new revenue will diminish over time and increase. Apple relies on increasing additional value for existing customers. Rouge. In 2017, there were 1.5 billion smartphone shipments worldwide, according to Juniper. And however, shipments growth will continue to slow over the next 5 years, since most consumers in the West now own a smartphone. Apple also faces huge competition from Chinese Android smartphone makers, who are releasing feature-rich premium devices, no doubt about that, cheaper than Apple and Samsung. So the game is changing. The HomePod is focusing on and providing music experience, while Amazon wants to use its Echo to control the lights in your home and manage your daily life. Amazon's Echo already has a higher household penetration than Apple's HomePod. And probably will continue to. Apple and Amazon challenges differ considerably. Amazon is primarily focused on e-commerce, but apart from devices, it also sells applications, has a cloud computing business, a very big one, Amazon Web Services. And it's in the TV content business also. Amazon has proven to be particularly lucrative. Its sales have jumped 49% to $6.1 billion in Q2, and operating profit to $1.6 million, in addition to owning the Washington Post. Apart from devices, Apple is mostly focused on streaming music at Apple. And, of course, it has to compete against various other services out at Apple, and each roughly worth for the value of 25 American companies. Now, this is amazing right there. And if you look at some of the companies here, $40 billion for Ford, Disney at $168 billion, Volkswagen at $83 billion. Let's give a few of these. Bank of America at $312 billion, Boeing at $201 billion, Kruger, that's the grocery operators, at $24 billion, Hershey's is up here at $20 billion, Hilton at $23 billion, and 20th Century Fox at $83 billion, eBay at $33 billion, General Mills at $27 billion. I didn't know that, but anyway, this just kind of shows you where they are. So you got to put 25 of America's largest companies together to make Amazon, and it sort of shows where things actually are going. Is a much more of a massive market player than Apple. With some instances, you could use Amazon every day, no doubt about that, and we do. On the downside, both companies have grown so large that they now face the threat of regulation from multiple governments, and to say nothing of additional taxation. Well, taxation is coming. That is part of what happens in a modern-day economy. From the BBC here, more on the growth figure. We don't see much happening here. When it comes to jobs, the U.S. job report for years now hasn't been the number of jobs created or the headline unemployment rate has been focused, but the mystery of the paycheck. Well, the paycheck improved at 10 cents. And this is where there's a lot of things going on here that you don't think of. You look at the 3.9% employment rate, but the 3.9% doesn't mean that much. Wages weren't yet rising fast enough. That is from Mr. Stephenson, the chief economist at Papillon Macroeconomics. But explained that further gains are in the pipeline given the lag from falling unemployment. Explain policymakers' intentions to keep hiking. Well, the Fed will keep hiking. There's no doubt about that. Now let's go to Larry Summers and look at these stress tests. He was at the Boston Fed. And a little bit of this, he explains excess savings, pursuing a shortage of investments. That trend has been partially mitigated by fiscal programs, the Social Security, Medicare in the U.S., which reduced to some extent the propensity to save. If we are likely to live in a world of systematic low interest rates, systematically more higher asset price multiples than we have in the past. Then the case for prudential regulations and for higher levels of capital requirements in banks and most financial institutions is greatly increased. Continued low interest rates, a feature of the 9-year-old U.S. expansion, where policy rate is at 1.75 to 2%, can produce asset bubbles, no doubt about that. Following the depression of 2008-2009, Congress, of course, passed some regulation to strengthen the bank system. One was the stress testing. In most recent tests, the worst-case scenario, a severe global recession with 10% unemployment in the U.S., plunging housing prices, a fall of 65% in the stock market. The nation's largest bank holding companies are strongly capitalized and would be able to lead the households and businesses during a severe global recession. That's what the Fed said on the 28th of June. The Fed asserts that if banks continue to pay out capital in the forms of dividends and share bailouts despite the severe scenario, but none would have any capital deficiencies. Comically absurd, this is what Dr. Summers said, that I would suggest a comically absurd conclusion that is a belief, but most elementary analysis of beta from those institutions, from those major financial institutions. And the fact that assertion continues to make has somewhat undercut what credible ones would have otherwise attached to very substantive efforts that have been made to strengthen financial regulations. His criticism follows a similar call from officials at the Cleveland, that is Laurie Mester, and the Boston Fed Eric Rosengard, and in Kansas City Fed Esther George, we remember her, and to use the current period of strong growth and raise asset prices to ask banks to build up capital beyond stress test requirements. They're not doing that. If cyclical pressure continues to build and financial vulnerabilities broaden, it may become appropriate to ask large banking organizations to build a counter-cyclical buffer of capital to maintain adequate degrees of resilience against stress. That is from Baynard. Where is she? A Fed governor. Anyway, nonetheless, the Fed passed the largest banks this year's stress test, some with conditions and adjustments to their payouts and payback plans. Deutsche Bank in June failed the test of its combined U.S. businesses. So that is one of the things on the horizon. I'll do workers win big pay gains. This is from Bloomberg. Workers finally get the raise, but the raise is not. Fatter paychecks coincide with rising worker productivity. We don't went over those numbers, and they were not as spectacular as they would say. The raise in companies' wage bills may not be bad for the market. That's according to Renaissance Macro Research, Neil Dada. Anyway, we see the economy growing at 3.5% annually this quarter after expanding 4.2%. Economists surveyed at Bloomberg, they see 3%. Output per hour rose at 2.9% annual pace last quarter, faster than in 3 years since labor costs, while labor unit costs fell 1%. Now, we went over that. And it's not as rosy as one would think. We're seeing a revival in labor productivity growth over the next 2 years as a stimulus from tax cuts, etc. higher government spending output, more than possible for growth in labor input increase. That's from Robert Gordon. He's an economist at Northwestern University in Evanston, Illinois, an expert on productivity. Lebanon said increase in both wages and productivity is being driven by labor market tightness. That hasn't happened so far out there. Excuse me. Robert Kaplan, he is from the Dallas Fed, says he favors raising interest rates to a neutral level of 2.5% and 2.7% this year. That is not bad at this juncture. Now, the administration argues that more efficiency lifts the annual growth to a plateau of 3%, compared with an average of 2.2% from the start of expansion that ended in 2016. So you're talking about 0.8% there. Old Credlow says the paychecks are getting fatter, but not fatter by much. The economy's long-run cruising speed at 1.8 per year. This is where the Feds look at it. You will start to have some drop as demographics change, and a number of other things to change. There are another thing, looking at the tech sector, you have these trillion-dollar organizations, Amazon and Apple. But what are their core products? Apple obviously is based on much of it on consumer products. Amazon is a little bit different, whereas they are a huge, ever-ending marketplace. But they also have web services, and now they're getting into the manufacture of smart devices, speakers, etc. They have Prime, so they have movies, and they're making their own movies. So they are diversified. And we looked at those two titans as the major, 25 U.S. businesses. They have more capital than 25. So, and that 25, whether it be Ford, some of the others there, some of the consumer ones, their year to year is more tenuous. They're constantly moving to new products. We didn't see Coca-Cola there, incidentally, if I remember correctly. So you'll have to look there. I worry that if you grow too fast and too much leverage fueling that growth, you'll have to pay that back in some time. That is from Michael Collins, a senior portfolio manager in Newark, New Jersey, at PGIM Fixed Income, he told Bloomberg TV. But right now, it feels good. Well, yeah, the American economy has been full of feel-good activities. Let me do Detroit here first, and then we'll look at the farm. The hubris here, if many remember, in days past, September would be the new models would be out. People would be rushing down to look at them. Ever wonder why you start seeing ads for next year's model several months early, thanks to creative release dates? The industry is historically sold tomorrow's more profitable vehicles today as the summer turns to fall. But that chronological magic is starting to fail, and increasingly being a focus to sell yesterday's cars today. In the decades since the recession, dealerships have started to find themselves in a pickle come September, leaving them struggling to get rid of current year models as next year's generations arrive. The inventory glut is largely a function of misplaced optimism, and this is one of the things that is in a number of industries. Edmunds.com, that's I don't understand the gravity of the situation. This is becoming chronic, a real issue in Q4 of 2017. Only 49% of new vehicles sold in the U.S. were shiny, new 2018 models, compared with 73% 10 years ago. To make matters worse, the stable product spilled over in the first quarter of this year. Almost 1 in 5 vehicles sold in the U.S. were the older 2017 models and even 2016. That's double the level before the recession in 2000, or before the depression actually in 2008. Matt Jones, he's a senior consumer editor at Edmunds, knows the challenge well. He spent 12 years selling sedans and SUVs in Santa Monica, California. These days, as he drives past dealerships on his way to work, he counts the share of old vehicles on the lot. The results haven't been encouraging. Some of the cars could potentially be sitting there since 2016. The glut is corrosive to the automobile market in a number of ways. Most directly, consumers find themselves with more power in negotiating table. The leverage comes at a cost of trimming profits for the dealer, the manufacturer, or both. Next year's cars tend to show up in August, adding to the current year's inventory, which dealers rush to sell before the end of the year, the 31st of December. Yet the crash will come as consumers grapple with rising interest rates and gas prices. They are also starting to keep vehicles on the road longer. New tariffs on aluminum and steel, aluminium, whichever way you want to pronounce it. Thanks to the trade wars, some of the things that equate in here. Year inventory collusion may be particularly brutal at Nissan. Last year, 1 of 5 Nissan vehicles sold was a 2018 model. Even by spring of this year, there were still 2017 trucks around at the various Nissan dealerships. GM is pleased with its inventory, so they say. Early this year, the larger car makers are still hustling to get rid of 2017 models. That was 59% at Nissan and 38% at Ford. Fiat Chrysler 25%, GM 25%, Honda 20%, 16% at Toyota, Audi only, and Subaru only 3%. You can see it's a little different there. Several of Ford's critical models launched relatively late this year. The Super Duty pickup truck, that's according to Edmunds data, which captured a sample of retail transactions and made the model turnover appear worse than that. Ford's internal data also captured sales to rental fleets. That's one of the big ones, government fleets. And most people don't realize the sale to government is basically what keeps many of these people in the business. And let me finish this up. Come November, those in the market for Audi or Outback won't find many bargains. Now, Jones at Edmunds suggests that buyers start casually shopping this fall and watch for the 2018 vehicles. This is in under our consumer's eye on the ball situation here. Now, let me go to the farm crop situation here. Rising export demand for the biggest U.S. crops, along with biofuels, have come into expensive grains that have long thrived through niche uses. Barley, which is for beer, is used less for food and feed. In the northern plains, as corn and soybeans come in, oats has less use as Canadian supplies most of the U.S. needs. Warmer weather plants have become more competitive. Further north, rice is limited to the Mississippi Delta and parts of California, has contrasted even further into a few counties where it continues to offer a strong economic return. Sorghum, which is more climate-proof but lower yields than corn, is becoming more concentrated in western Kansas, losing its place in rotation elsewhere while maintaining viability growth in China. U.S. field, what U.S. fields go next? If it passes a prologue, production of minor crops will continue to become more constricted. Still, disruptions remain. Shifts from long and short range of crops there. The Chinese can often fuel more sorghum production. A repeal ethanol rules could roll back corn gains, but nationwide diversity isn't likely to come back. Agriculture demands too much specialization in the 21st century, and regions of the U.S. are differentiating themselves from what they grow. Ebbs and lows of commercial here. We picked up a little bit of this. It's sort of, we're looking at some of the highlights of this report. Cotton, the iconic American South, may be affected by China trade as much as soybeans, but the cotton export boom has been a mixed, what he calls a blessing, while exports to China have exploded, with the world's largest clothing producer buying 1/3 of the crop. Cotton's only real growth has come from the western edge of traditional cotton belt and biotech varieties. Water-saving technologies have made the crop more viable in West Texas and Oklahoma, while warmer summers have pushed production into Kansas. Didn't know they produce cotton in Kansas. So some of the changes in how the big losers are corn and soybean is wheat. We don't hear much about wheat anymore. The most planted crop as recent as 1990. Competition grows in the Black Sea. The Black Sea is back. Lack of GMO varieties, inefficiency as cattle feed compared with corn and soy. Is a few isolated counties in the plains. Soy they won't get enough swaps near East Coast, where urbanites want locally grown brands, and farmers diversifying their crop rotation to control weeds. So, if cotton were in the same shape today, you wouldn't have had slavery, literally. Corn remains the top U.S. valued crop. Early this year, it lost its corn as the most planted agricultural product after being surpassed by soybeans for the first time in 35 years. Soybeans thrive in the same climate as corn. Both crops are frequently rotated to keep the soil healthy, something Dr. George Washington Carver perfected at the University of Iowa in the 1800s. Soy cultivation has risen in corn areas. Many places have switched to soy. Has been dramatic. Oilseed acreage has grown in places like Ohio, Michigan, Wisconsin, where, and also we look at Wisconsin as a place where you have ginseng. Most people don't know that. Then it's shipped to China and Korea. Where corn has been declining, soybeans have benefit from many of the same factors that support corn demand, although soy-based biofuel is nowhere near ethanol. U.S. soybeans increased at 15,000% from 1995 to 2017. The production region, formerly known as the Corn Belt, traditionally characterized as beginning somewhere in Ohio and ending somewhere on the Great Plains, needs a new definition. Acreage has dropped off in parts of the East, including Indiana, Ohio, and Michigan. Meanwhile, production has spilled into the Dakotas. It used to be wheat. East to north in Minnesota and spread across Missouri. Mini corn boom has occurred along swaths of the East Coast from eastern Pennsylvania to the Carolinas. That is very, very interesting. The Mississippi River. America's heartland, has the sameness that didn't exist a generation ago. Amber waves of grain are still there. The corn is still as high as an elephant's eye, but It didn't mention Iowa here, but less and less is likely to exist side by side. The global markets have grown. Desire and need for diverse local production has declined. There's no need for a little wheat here and a little corn there. The results have literally shifted the American landscape from the mid-90s, the time that genetically modified crops became prevalent. Unfortunately, the diversity of American fields have decreased. It's not just GMOs, although it has added to the spread of corn and soybeans. Ethanol, farm exports into China, cheaper transportation costs, increasing regional concentrations of feedlots. Now you have those in Iowa and in the upper Midwest. And in parts of Illinois, climate change even played a big role. So there's some of these things that are happening here. We thought we would do that. Let's do the numbers now. We'll start with the numbers from CNBC. We're sort of skipping around here. Financials were down. Energy was down. Technology was down 4.45. That's the change there. We'll get back to financials down 0.54. Energy down 0.31. Technologies were down a negative. These are all in the negative, incidentally, 4.45. And healthcare at 1.62. In Europe, we have the calc, that is in France. It was up 8.38. The FTSE was down negative 79.53. The stock is 600 was up 0.3. This is major European operations here. The X, this is in Asia, was down a negative 16.60 in Shanghai at 10.71. The COPSI was down a negative 6.3. The CNBC 100 was down 0.1588. And the VOX, let's see, change was a 23 there. And let's go back up to in New York. The Russell 1000 was down 3.64. And the NASDAQ was down 22.91. And the Dow was down 79.33 according to this. The Russell 2000 was down negative 1.29. I guess we didn't get the FTSE. We're sort of changing around here using this. Anyway, it was a negative 41.26. The DAC was up at 4.38. The Nikkei was down 180.88 for the Nikkei. And let me just jump over here and make sure we got everybody nice and neat here. The FTSE 250 was down negative 36. The 100 was down a negative 0.56. In Amsterdam, they were down a negative 1.6 %. The Euro stock was down a negative 8. And in Spain, they were down negative 0.41. I think we got the Dow. They were down negative 3.1. The Nasdaq was down negative 2.5. And out in Chicago, they were down. We don't have the anyway the commodities market out there. We're gonna have to search a little more. Negative 2.2. The Hang Seng, we finally got back to it. Was down 0.1 tenths. And the Nikkei at 0.80 in the negative there. The Cemex was at 0.38. We'll finally get to the commodities. Brent crude was up 33 cents at $76.83. West Texas Intermediate was down 2 cents at $67.75. Even in retirement, T-bill picking it, jumping for joy. Gold on the Forex was down $3.55 at $1,200.75. We don't have Dubai gold here anyway, I suppose. Moving from one to the next. And we'll see if we can get the Bloomberg. We usually like to get their commodities index here. We'll get them. The Bloomberg Commodities Index was down 0.19. It was at 170.69. That is where Bloomberg stands. And the UBS at 921.04. The change on it was 2.53. The Reuters Jeffers, we hadn't had that one yet. At 0.31. And we got energy. We won't mess with natural gas. We did gold on the spot. It was down $3.06 at $1,196.92. Silver lost 1 cent at $14.07. Platinum was down. All the precious metals were down $9.38 at $782.67. Wheat, we talked about wheat. It was down 0.49%. Cocoa was down $22. Actually, wheat down $2.50. Coin, what was that? Down 0.20. And I guess we got corn, wheat, cocoa, cotton. Actually, cotton was up, it looks like 69 cents. We don't have pork bellies here. Live cattle was up 1.08 for live cattle. So we're sort of going around here looking at anyone we can look at, I guess you'd say. It gets... did we miss anything? Going back to the BBC here. No, we got the commodities. We got everything. For once, we'll end this with cryptocurrency. Coinbase, cryptocurrency powerhouse, doubled its staff. This is from Business Insider. Bitcoin, the largest cryptocurrency, has shed 50% of its value since the beginning of the year. Coinbase, a crypto exchange, in recent weeks hit its target to double its staff in 2018. Coinbase, a crypto exchange operator, has... we already did that. In February, the firm told Business Insider it would double its staff. from 250 to 500. And that's basically where Coinbase is. The exchange on Thursday reported it had been looking into crypto ETF, known for its wide-ranging business model. It covers trading, asset management, etc. So cryptocurrency is on the march, we'd say. Nonetheless, this will do it for this weekend. Economics, a joint venture of the Numbers Man section of the Bostonred Network and WBRN Radio. Our partnership, as usual, with Cranston Analytics. The words spoken here, as they say, opinions are of the people we quote are our opinions, period. And the numbers that come from their respective origins, whether it be Reuters, the BBC, CNBC, the Wall Street Journal, etc. That's financial news out there. And, of course, we rely upon the Bureau of Economic Analysis in the U.S. here. And I believe we painted a pretty good picture of where things are going. The economy is moving along. We've seen a little ups, little downs. Effectively, 10 cents was the marker that people received in their quote-unquote on their hourly. So we're not seeing any explosions at this point in time. What we have seen is the adjustment, 50,000 jobs. What was that? June and July. But that's not unusual. Of course, again, all administrations tend to fudge things a bit. They have the power to do that, and they can revise it later. But you still have the problem, even with 3.9%. There are workers out there looking for jobs, and the jobs are not available. Period. Either they do not have the skills, some would say, or that the jobs that they would normally want to fill have already been filled. And some of the less desirable jobs have either been withdrawn from the market or they literally can't afford to work there. I was talking to one young lady. She's working 2 jobs and her fiance is looking for a job. But, there's a struggle there, so she's able to keep the household, as they say, humming along. And she's expecting to earn more money between the 2 jobs. So this is some of the story that you have. It's not quite a Dickens novel for some it is. The best of times, the worst of times, in the middle of times, etc. As far as interest rates, that will eventually affect their credit card debt. People that are buying cars, we assume that they will shop around and buy accordingly. It's their deal-making time on their eye on the prize for the consumer. For businesses, you look at the government's part of this equation. It has been a larger part. The tax cuts are now in the economy. Will you get any residuals in 2019? Perhaps you will, some, but not as much. There's been more of a normalization there. And then, of course, we look at the various portfolio. The Titans at $1 trillion, less than £1 trillion. That is at Apple and also at Google. Or Apple and Amazon, excuse me. But coming Google. But these companies are all based upon, at least Amazon, upon where consumers are and consumer confidence. We'll monitor that very, very closely. It's not as rosy out there as some would paint it in terms of consumer confidence. Now, the market itself, there's a lot of positive psychology out there. We're talking up the market, which a lot of the time during the administration of Barack Obama, you saw a negative market psychology being put out by the major financial publications, and many of the analysts. When you had 2.2, 2.3, 2.5 growth annually, and President Obama will remind people that on his march this trend started, no doubt about it, and because of quantitative easing or a looser money policy. But when you have this artificial type of situation, it existed for 10 years after the Depression, very, very long time, and still exists today. So you're now starting to get a little bit of normalization, very little, because what you had was a huge tax cut. That is normally not done. And then you have government stimulation, or what we used to call pump priming, still out there. And anytime you do those things, you artificially stimulate the economy, basic Keynesian economics. But the problem is modern industrial capitalist economy is much more complicated. We have the emerging markets. Now, early in the week, there were some reports on some of the emerging markets not emerging as strong as one would think. At the end of the week, we don't have that. We'll have it next week. This will do it for us. Have a good week. For those in business, make it a productive one. The consumer obviously is keeping the eyes on the prize. This is September. We haven't heard about the back to school, but we'll get into that next week.